Some of the best investing advice out there says that you just invest regularly into index funds and you'll be rich. And even the big man himself, Warren Buffett, has said this multiple times on TV and countless times in his famous letters to Berkshire Hathaway shareholders. The problem is that there are literally thousands of index funds and ETFs out there on the market that you can invest in. So how are you meant to know which ones you should be investing in and which ones might end up costing you a lot of money? I remember when I started investing years ago, I wish that someone had walked me through all of the different options that there were and explained the key differences that there were out there, including what to avoid and some of the common traps that beginners can easily fall into. So consider this video your ultimate guide to picking the best index funds. I'll run through the differences between mutual funds and ETFs, explain how the costs and charges work. We'll then look at how to find the best funds and also speak about where you should invest. And hopefully by the end, you'll be in a much better place than I was a few years ago. First up, a quick refresh. When we talk about index funds, we're talking about the type of investment that allows you to buy a share in many companies at once, which all belong to a certain index. The idea behind them is that by pooling lots of investors' money together at once and then purchasing company stock, it's a much more efficient way and an easier way than trying to buy hundreds of companies yourself, which would not only cost a lot of money, but also cost you a lot of time and commissions. There are a ton of different kinds of indexes out there, everything from the famous S&P 500 and the Nasdaq to the FTSE 100 and dozens of other indexes which track stock markets all over the world. If you want an easy way to imagine an index, just thinking about your favourite sports team in the league that they're in. For example, if you imagine the UK Premier League for football, then this is pretty much the index of the best football teams in the UK. The biggest and the best teams will sit at the top, and then gradually you'll work your way all the way down to teams like Leicester. Poor old Leicester. Anyway, you get the idea. Inside an index fund will be all of the companies from, you guessed it, the relevant index, and they'll be weighted according to their market cap, which is just a fancy way of saying that the big companies will get most of the money and the small companies will get less money in that fund. Now, there's loads more we can talk about, but I don't want to make this video too long, so let's get on to our next key point. What are the different ways that we can buy index funds and why does that matter? Here's the best way I can explain this one for you. So imagine either some kind of big circle, and inside this is where all of our index funds live. Now, not all index funds are the same, and you can buy them in two main ways, either in the form of a mutual fund or an ETF. An ETF just stands for Exchange Traded Fund, and we'll go through all of the details in just a moment. There are a few key differences between the two, and it's really pros and cons depending on what you need as an investor. Mutual funds have been around for many years and ETFs are relatively new to the investing scene, having come onto the market in the 1990s, but they've since rocketed to fame as they've been really popular with investors. Here are the main things to consider though. A mutual fund is something that is priced once a day, it's not traded on the stock market, and you can typically buy them in as many fractions as you like. And by that I mean if you invest £100 or $100 into a mutual fund, you'll get exactly £100 or $100 worth of the fund. And this might sound obvious, but it will make a bit more sense when we compare it to exchange traded funds later. Some of the largest providers of mutual funds in the world are companies like Vanguard and Fidelity, with Vanguard being really the biggest dominant player. The largest mutual fund in the world is the Vanguard Total World Stock Market Fund, and it's got more than $1.3 trillion inside of it. Buying a mutual fund can be done through an investment platform or broker, but some platforms might not have access to mutual funds, so you might actually have more options when you use ETFs. Mutual funds that follow popular indexes can be really cost effective as well with low fees, and remember that fees are extremely important in investing, and generally we want to keep them as low as possible. You'll find these fees that funds charge when you search for them and find something called the OCF, which stands for the ongoing costs of funds. If we use this as an example on screen, we can see that the ongoing cost of something like Vanguard's FTSE Global All Cap is 0.23%, which means that for every £1,000 you have invested here in the fund, they're taking £2.30 per year. Now a quick note here just to say that there are hidden costs, and don't forget that about the cost of the platform too. Some platforms can charge a lot of money, whereas others are free or very low cost. So feel free to use platforms like Trading 212 and Vanguard directly for low fees. I've always got the latest links in the description of my video if you do want to open any accounts. One more thing on mutual funds before we talk about ETFs. Sorry, I know it's a lot to cover, but I promise it's all worth it. I knew none of this when I started. You'll also see that sometimes mutual funds can come in two flavors, either accumulation or distributing. Again, this is annoyingly complicated wording for something that's really simple. Accumulating just means that any dividends get reinvested automatically, and distributing means that they'll pay you out money, usually every 3 months, from all the cash that the businesses they've got make for you. In my opinion, I'd say that if you're someone like me looking to build wealth over the next 20 to 30 years, then we may as well use accumulation where we can, as I don't really have any need for dividend payments, and I'd rather get them reinvested to help compound wealth over a long period of time especially. Over a long period of time, these dividend payments can really add up once you get them reinvested. But on that point, just do whatever works for you. If you like seeing a bit of income and you want to either spend it or reinvest it in something else, then just do you. Now, jumping over to ETFs, the major differences really are just the way that they're bought and sold. The clue is in the name ETF, being an exchange traded fund. An ETF still can have all of the same companies inside of it, but rather than get traded once a day with a set price, an ETF can be bought and sold all day long. There are a lot of similarities, but you might find that ETFs can sometimes be a little bit cheaper in their fees, and you'll probably find them on more investment platforms compared to those mutual funds. Outside of that, the biggest difference is that you'll need to make sure that you have enough money to buy a full share. Unlike mutual funds, if you do want to invest a fixed amount each month, say £100 or £200, then you'll probably end up with some change left in your account. For example, one share of VUSA, which is a popular index fund that tracks the S&P 500 that I invest into, is around £65. So if you want to invest £100, you'll end up with £35 left over. Bear in mind that while I'm saying this, mutual funds will also have minimum purchases, whereas an ETF just needs you to buy one share. Again, be careful when you buy ETFs. If it's an expensive platform, then you might end up costing yourself a lot more money, so a mutual fund could work out better, unless, like we said before, you can use a fee-free trading platform like Trading 212 or even InvestEngine. There are a few other differences, but for this video, I hope that's useful. Decide what works for you, and also, if you want to own both, then feel free as well. It literally is all up to you. And just before we jump over to the next section, if you are enjoying the video, please do me a huge favor, hit the like button, subscribe too, it's all free and it really helps out small channels like mine get to more people like you. And with that done, let's keep going. Okay, now next up, this one's pretty important. What kind of mutual fund or ETF is right for you? I've done quite a few videos on this topic looking at domestic stocks, international, small caps, tech stocks, etc., and even bonds. Generally, you've got to decide what you want to invest in. Now, broadly speaking, you'll have to find an index fund covering everything from the entire world to a specific country and even specific industries if you want to go that far. But for most people and starting out, you'll probably want to keep things nice and broad. If you look at the most popular mutual funds in the world and also what's popular with investors based here in the UK, you'll see a pretty common theme. In the US, you'll see that the most popular funds cover the entire US stock market, or the S&P 500. There's no surprise there when you realize that the US stock market is the largest in the world, with some of the most famous and powerful companies in the world. Here in the UK, from looking at some recent data, the most popular funds are similar. You'll also see lots of global funds, but also some mixed funds as well. Something we've not focused too much on in this video, but worth noting is that you can get multi-asset funds, which is another fancy way of saying it's got both stocks and bonds inside of it. Note how the Vanguard Life Strategy range is pretty popular here. These can hold certain amounts of bonds inside of them alongside those stocks to help investors get through more difficult times and protect their investments too. Now, if you're trying to figure out what the best thing to invest in is for you specifically, I'm going to need your help here because it's not really as simple as saying buy this and everything will be fine. Personally for me, I'm happy with investing in mostly the S&P 500 and I share all of my portfolios publicly on my YouTube channel. But for you, you might think you want to invest in stocks from all over the world and not just the US, so maybe a global fund is better for you. Also, you might be concerned about a stock market crash right now and think that waiting in cash is best. Now, personally, again, I'd avoid trying to time the markets and get yourself invested sooner rather than later. Probably one of my biggest lessons and almost something we always hear is that I wish I'd started earlier. Also, let me show you what it looks like in history when you just invest regularly. Remember that you don't have to get the timing right to make a lot of money here. Investing is about being consistent over a long period of time so that even if you get really unlucky and invest just before a huge market crash, you'll have years worth of investment still to make up and your average cost will get reduced if the stock market drops. As an example, let me run through a few different scenarios here using a backtesting tool where we'll pretend that we could have gone back in time and started investing with a couple of hundred per month. Here's three different options, one being the S&P 500, which is represented by this Vanguard mutual fund. Keeping our money in cash is our option 2, and then finally a global index fund as option 3. Now, unfortunately, this data only goes back to 2008, but it still will give us an idea of what you need to get through as an investor. So as you can see on screen, keeping cash is never going to end very well, so there's no surprise there that this one's last on the screen. Coming up close second is our global fund, and then in the winning position would be the S&P 500. A couple of things worth noting here before you make any wild decisions. We have been in a really strong bull market since the end of the financial crash since 2008, so stocks have done really well on average, and also US stocks have had an amazing ride so far. And I wouldn't just base my investing decision on the past performance of the stock market because we really want to know where things are going next, which, as you might guess, nobody knows. Another thing to say here is that investments can just as easily go down as they go up if the last few months have been anything to go by, and if you want to invest in funds, you need to be ready for crashes and corrections as these are really just all part of investing. It's really difficult to watch your investments fall in value, but it can happen, and it does happen really often. So it could even happen over many months and years. The key thing is making sure that you stick to whatever plan you have and don't just sell out the moment you see things going down. Unfortunately, that is what a lot of retail investors do, like you and me, and I've definitely done this in the past more times than I'd like to admit. Okay, so I can't give you the perfect fund that's right for you, but I can give you the right information and some guide as to what to look out for, which leads us to one of the final points on the video. Where do you find mutual funds and ETFs? The answer is that there's loads of great sources on the internet, including your own investment and brokerage platforms themselves. You've got sites like Morningstar as well, which have screeners on them, allowing you to search and find different funds depending on the filters you apply. So for example, you might want to make sure that you find a passive fund that invests in the UK market, or you might want to find something that's global. Also, similar with ETFs, you can search useful websites like justetf.com, which is an easy to use way of finding ETFs that we can invest in here in the UK. One thing to add here is that for UK investors, we need to invest in UCITS ETFs, and we can't invest in US-based ones, just to be aware of that in case you do see any US-based content creators speak about ETFs like SPY or VT or VTI. You'll need to search for the UK equivalent ones, which are authorized for us. I did a whole video on this one in case you want to check that one out later. Now, just before this video does get too long, remember to be careful also about what kind of investment accounts that you buy your mutual funds and ETFs inside. Make the most of your tax advantage accounts. This topic is a whole video in itself, but look up accounts like your stocks and shares ISA here in the UK, and also for US investors, make the most of your Roth IRAs to help build your wealth and remove any capital gains or dividend income taxes. All of these can add up over time and really cost you a lot of money, so just be aware of this. Now, that pretty much wraps things up. Keep a close eye on those fees. Make sure you understand the difference between a mutual fund and an ETF, and also keep a close eye on what platform you're using and what kind of account. I know there's a lot to cover, but once you understand the basics, you'll be in such a good position to really start building your wealth in that long term. If you're looking for more advice, see my Investing for Beginners playlist where I've covered off everything you need to know to get yourself started. And until next time, drop me a big like on the way out, subscribe for many more, and as always, guys, happy investing.